Alice, Autonomous Learning Investment Strategies. We call it the next investment process paradigm, which is a bit of a mouthful. The third wave. I will. I'll talk more about that. Why we say it's that and what it is. So, first of all, the first wave of investors were discretionary managers, like the Soroses of the world. I was formerly a portfolio manager at Soros. The second wave of investors were or are the quantitative or systematic investors. You may know firms like AQR or Bridgewater, firms like that. We're saying there's a new wave, a third wave, and these are ALICE managers or these autonomous learning investment strategies managers. And what we're saying is it's a function of the confluence of these five factors. There's no pointer, but one, so the exponential growth of data. Two, data science. Three, machine learning's working. Four, low-cost computing, processing and storaging. And five, the information edge is a risk. That's probably the least obvious. The first 4 points should be pretty obvious to everyone in this room. And I'll try to leave 5, maybe even more minutes at the end for Q&A. So for context, we believe a good analog here is Uber. Uber was the confluence of 3 factors, right? GPS, cellular, Wi-Fi networks, and phones, and the internet. Without any one of those, you wouldn't have had Uber. Uber was highly disruptive to the taxi and limousine industry, as again, many of you in this room probably know. For example, I live in New York City. New York City taxi medallions are down by 90%, 90, because of Uber. They were previously a monopoly that was disrupted. And our view is that ALICE managers will have a similarly disruptive impact on investment management. So the quadrants of data. 4 is a bit redundant, but anyway. Thanks. So the top left quadrant, that's structured financial data. The other 3 quadrants are the unstructured non-financial data. That's where we think the opportunity is in the future for ALICE managers and from an investment management perspective in terms of generating excess returns and or alpha, as we call it. So data is growing exponentially. Again, many of you in this room probably know that, but I see some of you taking photographs, which is good. So the important thing here is that structured financial data on the bottom, and you're welcome to take photographs of any of it. The structured financial data on the bottom, that's pretty mature. That's not growing exponentially. That's sort of the old data, the data that the first and second generations of managers used, like the discretionary managers like myself formerly and the traditional quant managers. The unstructured and non-financial data, that's where the opportunity is from an investment management perspective. So that's those 3 quadrants. And again, that's all data that everyone in this room knows. Sentiment, credit card, GPS, geolocation, corporate exhaust data, all the stuff that doesn't easily come in Bloomberg or FactSet or Capital IQ. The stuff that, you need data science to deal with. We'll get to that in a second. So this is a slide of the number of data providers, alternative data providers. And I think this, quite frankly, is understated, but in any case, it just gives you a sense that the growth is also exponential. Now there are multiple hundred alternative data providers. And note that these are only like data aggregators. So like if you're running a hedge fund or an investment management firm, these are alternative data providers who might come to you and try to say, we have all these data sources. This doesn't account for the exponential growth of data necessarily. In other words, there are so many other sources out there. So how to interpret the data? Again, everyone in this room gets this concept. You need data science. You need to cleanse it, normalize it, parse it, organize it, classify it for this unstructured non-financial data. Again, if you're on Wall Street, the top left quadrant, the structured financial data is easy. Comes in spreadsheets and rows and columns and, or whatever the case. So that's the sweet spot for ALICE investors, these 3 quadrants. So is the investment game too complicated? Well, it's been said before that computers couldn't beat human in these board games. In '87, Kasparov said, "No computer will ever beat me." A leading scientist at Princeton, so Dr. Piet Hun there, he thought it would be 100 years before a computer beat humans at Go, and obviously everyone in this room is familiar with AlphaGo and Go Zero. Go Zero being even more incredible, right? So it took 38 years for checkers, 12 years for chess, and only 6 years for Go. And again, that doesn't even account for Go Zero, which, I think we would all agree is even more incredible. And for context, checkers only had 10 to the 20th permutations. Go had 10 to the 700th permutations, more atoms than there are in the universe. So we don't believe the investment game is too complicated, but it's much more complicated. So we don't believe it's too complicated, but it's much more complicated than many of these games. And it poses a different set of challenges. And this is one of the things that I'll talk about shortly that people in this room may or may not be aware of. Because what we find often happens is people who are ML or AI experts, using it for certain challenges, find, it's much easier than on Wall Street. And again, or predicting security prices. Again, I'll get into more detail on that momentarily. So here we say making decisions under conditions of uncertainty with incomplete information. At Harvard Business School, that's what they tell the students that they're going to learn how to do at Harvard Business School on the first day. And now what we find is, computers can do that better than humans. So as, in 2017, again, many of you in this room may know, 2 universities beat humans at Texas Hold'em Poker, Carnegie Mellon and University of Alberta. Maybe there are some people here from one of them. And the reason, we think there are 2 remarkable achievements that seem simple for humans but aren't for computers is, one, there was incomplete information, that the cards were hidden, obviously, compared to the prior 3 board games where all the pieces are seen by both opponents. And the second is there was bluffing. There was bluffing. So we joke that computers can now be taught to prevaricate better than humans. Computers can lie better than humans. And it's pretty funny, right? It's pretty interesting. And the other element to that was the computer when the computer bluffed. I see some of your smirking, and which is good. When the computers bluffed, it did things that were not common for humans. Like a human might bet $40, the computer might have bet $30.92, and that things that were different, which we thought was neat too. So this isn't a false dawn. Everyone here, I would assume, knows that there have been multiple periods over the past 70 years where machine learning's failed or disappointed. Now, though, obviously it's surpassing humans at tasks that were previously unthinkable. This is just the ImageNet visual recognition challenge. And for multiple years, computers have had a lower error rate than humans. So our view is it's man or woman plus machine. It's human plus machine. It's not machine only. I was just in one of the prior lecture with a fellow from MIT. I can't think of his name, but and he was espousing a similar view. Probably not uncommon, but our view is, including in investing, you don't just let the machine do what it wants or unconstrained. It's very much a human plus machine endeavor. And people like Gary Kasparov have come around to share this view. Sorry, I guess I should just say that was man or woman and machine only, and then man plus machine in the top-rated chess matches at the time. Again, something that some or many of you may be familiar with. So these are processing costs, and they've declined exponentially. So what cost $1 million in 1980 costs 4 cents today from a processing perspective. So that's obviously logarithmic, and this is a democratizer in our view. So when I'm a member. Let's see. I work with 2 firms. One is called Protege Partners, and one is called Move 37. So Protege Partners, some of you may know, we made a bet with Warren Buffett that we're pretty well known for over 10 years that hedge funds would outperform the S&P, and we formed this new firm called Move 37 to focus on machine learning and alternative data managers, because we think this is the third wave and will disrupt the traditional investment management industry. And the point is, 16 years ago when we launched Protege, our view was that small emerging managers couldn't invest using systematic strategies because they couldn't compete with the largest managers, because they couldn't afford it. They couldn't afford the T1 lines, the processing, the storage, the PhDs, and all of that. Our view is now that's completely become democratized because of that confluence of 5 factors on the first page, and particularly including this. Now anyone can afford to do this, in our view. It's become quite affordable. And so small emerging managers can compete and will disrupt the large investment managers in the establishment. So, let's see. Oh, in fact, it's funny. One manager we know in Boston was using machine learning and large amounts of data and processing to determine technical signals based on price and volume, for example. And the manager got a call from the NSA who said, like, what the heck are you doing? Because they thought it was a terrorist organization or something, that they were doing nuclear things or something else, because they were using such immense amounts of data and processing. And that's a true story. And again, that manager, for example, can discover technical signals for like a couple $100, and could run immense amounts of capital with them, and has done it successfully so far on smaller amounts of capital, but they are scalable. Okay, so the third wave. There is a fair amount of text on this, but the gist of it is, we previously mentioned the first wave. Those are discretionary managers. That's like the Soroses of the world, where I used to run money, I mentioned. And the second wave are the traditional quants, like, again, I mentioned like Bridgewaters, AQRs. We're saying that this third wave are the Alice managers. And they, so they're using the unstructured and non-financial data. They're using the data science. They're using the record load processing and storage costs. And they're using machine learning, which is working. And then there's going to be one more element we'll talk about shortly. And so, the information edge. This was the fifth factor from the confluence of factors on the first page. And so in 2000, I was a technology portfolio manager. I invested in technology companies. And I remember when Reg FD passed. And basically, that said that companies must disclose the same information to all market players or participants or investors at the same time. And it was almost as though companies could disclose, prior to that, companies could disclose material pieces of information selectively to large investors or certain investors or at certain events or conferences. In 2000, that came about. And then many years later, the SEC really started aggressively enforcing insider trading. So in 2013, a large well-known hedge fund paid a $1.8 billion fine. In 2014, one of the PMs there went to prison for 9 years. And so now we joke with the monopoly characters that, you know, if you're an investor in the first wave, so up there, discretionary, so these are like the MBAs of the world where you're getting better information from companies and their management teams. You have three choices. You back off the edge, meaning you don't get better information, because if you do, you either pay a fine or go to jail. And so what we're saying is if we're in a world of that, being discretionary and not systematic is a disadvantage. And being systematic where you're using anonymized data is a material advantage. And you don't have that risk because you don't, again, obviously assuming your data is procured appropriately and all the data issues that you've gotten it, the people who've given it to you have given you consent, and there's no PII information, obviously subject to all that, you don't have this issue, which we think is another factor. So, by show of hands, how many of you know of some of these managers on this? Great. So some of you, good amount, good, more than half. Great. So, these are generally like multiple of the largest, best existing second generation or second wave quant funds or systematic managers. I worked for FRM, which is affiliated with AHL, and anyway, I've been invested in multiple of these funds over my career over the past 25 years. So these are the 800-pound gorillas now. Our view is Alice managers are the next generation of these managers, and that these managers actually have an issue that's material, and I'll talk about that on this slide. They're legacy firms. These are, that's a photograph of a hansom cab in London in 1895, obviously on the cusp of being replaced by the automobile. So the best Alice firms are relatively young. Legacy firms are generally older, and they're inherently not Alice. They're large established firms that have often been around for a decade, sometimes even multiple decades. So again, they're these firms like this. They typically have hundreds, and in some instances, over 1,000 employees. A firm like Two Sigma, which is up there in the bottom right of the dendrogram, has over 1,000 employees. They may have their own in-house server storage. They typically have multiple offices around the world. They're systematic, and they generally rely on either academic finance, so fundamental data, and or old-fashioned technical models such as trend following or mean reversion. So like some of the CTAs here, like Aspect, Winton, AHL, or CTAs, typically they rely on trend following or mean reversion. And they rely on linear regressions, price volume, very, what we would say is rudimentary models compared to what managers can now do with machine learning techniques, as have been discussed at this conference today and will be tomorrow. They're often very large firms in terms of AUM, like minimum of 5 billion, and they're often 10 billion or over 100 billion on this page. And they don't use much, if any, alternative or unstructured non-financial data. They're really in that top left quadrant, structured financial data. Now, from a marketing perspective, we would argue many of them say they are using tons of machine learning and alt data, but actually, when we drill down with our team of PhDs, we find that they're not. Sometimes they hire PhDs with machine learning expertise or who are experts so that they can parade them out to clients and say we do have machine learning experts. But again, it's often from a marketing perspective. And again, we've spent hours with many of these firms. We've signed non-disclosure agreements. And again, they have this legacy problem. They're built, in our view, on old technology, often with monolithic intense models or immense models. And they use the Henry Ford early 20th century production technique, where each quant or PhD only works on a very small percent of the model: trading, execution, alphas, or risk management, or a particular strategy, asset class, or security. So in other words, they don't want anyone to be able to leave and replicate the firm. So they, Henry Ford style, partition everyone off. You do this alpha, you do that security, you do that asset class, you do risk, you do portfolio optimization, you do, and so everyone's cordoned off. And so our view is, that will be disrupted by these Alice managers. And our view is that at the extreme, even if these firms realized this, and what could they do at this point? No one would be so altruistic. If you're a legacy firm like one of these, you wouldn't say, hey, we have this system with 1,000 people, multiple offices, in-house servers and storage, hundreds of people work on the models, but we think there's a better way to do it. For those of you that know Jet.com, which was acquired by Walmart for multiple billion dollars, Jet.com was a money-losing startup, and Walmart's been in e-commerce for 20 years unsuccessfully, and they acquired Jet. And now they're actually showing a modicum of success because they acquired Jet. Jet was a startup founded by one of Bezos's right-hand men and women. So our view is it's similar here, where these legacy firms have a problem, but they can't do anything about it. So where's the talent? And possibly some of the talents in this room here. So I have a Columbia MBA, and I teach at Columbia Business School for the last 6 years. And I think very highly of Columbia, as well as the other top business schools. But let's start with where Alice managers are not coming from, and that's business schools. As Jim Simon said in that quote on the top, I have one guy who has a PhD in finance. We don't hire people from business schools. We don't hire people from Wall Street. We hire people who've done good science. We entirely agree for the third wave of investment management. We also think that they come from the counterculture. Gamers, again, some of you in this room may be gamers, hackers. We think that there are really four sources. So existing quants, so those are some of the top firms you just saw. Industry, FANG, Facebook, Apple, Amazon, Netflix, Google. Top universities, hackers, gamers. That's where we think. And as Clayton Christensen said in The Innovator's Dilemma, disruption typically comes from the outside. And that's where we're seeing it. So some Alice managers are coming from, those funds. A lot are coming from these other places. And again, we're also seeing, people at these top quant managers not wanting to be a part of it or wanting to do their own thing and have, be involved in the whole process, not just being a, Henry Ford style working on a very small niche part of a very large model or firm. And we know people who have quit some of those top firms to launch their own Alice funds. Let's see. Okay. So, what have we done? That's an old map of the world, and from the old exploration days. And we've traversed the globe, and we've searched the world for the best Alice managers. So we've gone around Asia, Europe, North America, and we've met with more than 200 Alice managers. Only a fraction of those are listed in industry databases like Eureka Hedge. And very few are running over $1 billion. Only a handful, literally. So we think we're in the first inning of this. The vast majority are running sub 100 million. Many of them can be running $1 million less, few million, 5, 10, 20. These are small emerging managers, what we've done for 16 years, meaning investing and finding in these managers. And I'll tell you where we see the opportunities shortly in the presentation as well. There are 3 sort of categories. Let's shift gears for a second to hopefully keep it interesting. They have to be cohesive. So what we're saying here is the data, the features, the model, the portfolio construction has to be cohesive with the philosophy and everything else. And we'll provide more details on these factors momentarily. So, okay, time is not interchangeable. So, in the time between the cat photo on the left and the one on the right, the cat has not changed materially, if at all, in over a century, right? It's pretty much the same cat. So if one's training a machine learning algorithm to identify cats, the photo to the left is equally effective as the one to the right. It might be a little fuzzier or more granular, but you get the gist. Cats are interchangeable over time, or stationary. Aside from the fact I chose a cat riding a bike, so it's non-stationary. But, right, thank you. Thank you. Glad there's still humor at this late into the conference before cocktails. So, joking aside, but financial markets, they're not stationary, and it's not the case at all, right? So an Alice manager is not likely to get very far with an algorithm trained on century-old financial data. Cat training is commutative, right? Whereas financial data in markets are not commutative. Markets evolve now more quickly than they've ever have, and cats do not change materially over a century. This is a financial problem that's not prevalent in many other machine learning challenges and makes using machine learning for investing or Alice funds more difficult. And I can tell you, we've met with some Alice funds, and they've invested inordinate amounts of capital and years and PhDs, and they haven't made any money. And these are people who are very successful in Silicon Valley and the companies that I mentioned, in the FANG companies, et cetera. It's much harder using machine learning on the markets than it is for other challenges, in our view at least. And again, having met with over 200 managers trying to do it. And which is, I think, more than anyone else in the world, but definitely in the top handful of meeting with these managers. So simulation is very hard. So this is a small section of the combinatorial game tree for the game of Go. The branching factor, or number of possible moves in any position, is about 200 for Go. Go can simulate games because there are rules, and one can see if the path taken was a good one. In chess, there's a finite set of rules and moves, and similarly, one can simulate which moves lead to winning. This compares to finance, in which simulation is very difficult. An Alice manager can simulate the market a large number of times, but there's very little confidence. There's no endpoint, as there is in chess or Go, to train on. Other machine learning problems don't have to deal with this dynamic. This also makes machine learning for investing in Alice more difficult. Discovery of alpha changes the market. So earlier I mentioned I was a portfolio manager at Soros and other places as well. One of Mr. Soros's theories was reflexivity in the financial markets. Just as in quantum theory, the way observation may impact the very particles one is observing, that participants' acts affect the markets they're participating in. Selling, for example, selling begets selling, which in turn begets lower prices, which begets more selling. One can possibly see some of this in the first half of the chart. That downward trend, that sort of momentum-oriented downward trend where people sell, the price goes lower, more people sell, the price goes lower, et cetera, et cetera. That's reflexive. This compares to many other machine learning challenges which are not reflexive and don't change based on the other participants. Also, markets are potentially nonlinear and non-contiguous. Apologies, I don't have a pointer, but if you look at that large spike in the middle, so that's price on the top, that's volume on the bottom, you'll see the volume spike and the price spike. That's an example where markets are not necessarily linear or contiguous. So, you to exploit that jump, you had to be in the security long, or have ideally either covered your short or been long before the spike. Once it started spiking, it was too late. And again, in investing, your model can't assume. Your model has to know. In other words, your algorithms have to assume that it either was in before, or it's getting in after, or at the top of that, but it's not getting in the middle of that. And that's a very important thing. So we'll talk about backtests shortly, but that's one of the reasons why backtest pro formas hypotheticals are worthless, for example. So that's another challenge that's prevalent in applying machine learning to investing rather than other, what we would argue are simpler challenges. Known patterns are not alpha. So the chop chart's an example of momentum. For example, stocks going up, just like we had negative momentum on the prior page, you've got positive momentum here. The bottom's mean reversion, we could say, like, thing goes up, it goes down, it goes up, it goes down. So when it's up, you bet it's going to go down. When it's down, you bet it's going to go up. Two very simple financial concepts, right? These are common factors. You can get these for almost no cost via smart beta, ETFs, or factor investing. This is like free in terms of paying for it, these concepts. So if an Alice manager develops a machine learning system and discovers these two factors, it's a bit like rediscovering the wheel. Well done, but there was no need to use machine learning to do that, and it's of very little value. So it's sort of it's a bit like the antithesis of Occam's razor. So Alice managers should discover complex, interesting, and novel patterns or alphas to generate returns in excess of market returns. But so there should be validation. So obviously we've got the queen there in the middle, and if for example, let's again use a gaming analogy. If one's chess algorithm doesn't conclude that one shouldn't sacrifice the queen, it's probably a bad algorithm, right? That you shouldn't sacrifice the queen. We're saying if you don't figure that out, you probably don't have a great chess algorithm. So though the alpha or excess return will not come from the obvious, like these two, the alpha or excess return is not going to come from rediscovering the wheel, momentum or mean reversion. At the same time, your model has to discover the obvious along the way as part of it, and then build on it. So first, finding the obvious first helps validate, but that can't be the end conclusion. That's not where the alpha or returns are going to come from. Low-hanging fruit, already heavily exploited. So we say designing a bespoke pair of sneakers probably won't get you to the Olympics. Probably should have used something more, well, the Nike bespoke. So anyway, so searching for alpha on the low-hanging branches is similarly not likely to generate excess returns for Alice managers. So for example, we'll say like price volume data. Price volume data is basic technical data. That's like this data. Sorry, I'll go back to the chart for those of you that were taking a photo in a second. This is price volume data. That's very prevalent. It's very used. It's out there. Like that's probably not going to generate excess returns at this point. However, an Alice manager may ensemble that data, the price volume data, with other data sources, and there may be alpha from that. So an analog one might use is it's a bit like mining with a sieve rather than looking for big nuggets at this point in time. All right. Acronym soup. This is something a sort of joking term we came up with. So what we found is the best Alice managers optimize machine learning techniques and focus on depth rather than superficial coverage. They understand exactly why they use a particular machine learning technique. They don't build the code from scratch, but they don't necessarily just use off-the-shelf code. They may custom tailor the off-the-shelf libraries to suit their needs. But the worst managers fall into what we call acronym soup. So like a due diligence meeting with one of these managers might be something like this. What kind of machine learning do you use? And then the Alphabet Soup Alice manager will say, we use SVM, PCA, NN, NLP, and KNN. And usually that's like a red flag to run away. Right. So, you know, let's see. So typically there's an inverse correlation between the number of Alice techniques and the quality of the machine learning and fund. But there is no panacea. There's no one type of machine learning that works best. Different machine learning techniques work better for different challenges. So it's like the philosophy slide we had. It has to be cohesive. Backtest heaven. Again, I'm at a machine learning conference, so you all know backtests. But the top decile of Alice managers that we've identified, they all have actual track records with real dollars invested. The returns are impressive, not only in terms of level, but in terms of quality, meaning up months, down, ratio of up months to down months, positive returns to negative returns, things like that. They're typically not correlated to the markets, and they're generated by idiosyncratic sources, not those free factor sources. We also don't invest in long-only or long-biased managers because, again, we want to pay for what we call alpha or excess return, not market returns. So the worst managers live in backtest heaven, what we call. And basically what will happen is they have this backtest pro forma hypothetical. They'll come to us. The numbers are off the charts. The Sharpe ratios or the return per risk are off the charts. And then when they actually launched, it's hysterical. It goes from, up 20, 30, 40% to flat or even losing money in many instances. And we see this all the time. And this is why we wouldn't invest in a backtest pro forma or hypothetical. And again, I don't need to talk about why there's overfitting. You all get that here, I think. But the point is, particularly in investing with machine learning, it so lends itself to overfitting. So, why do you think there's alpha? Well, we've come up with sort of 5 sources. There might be an information edge. There might be a behavioral bias, machine bias. There might be an analytical edge. There might be a market microstructure edge. There might be regulatory structure rationale. What I think I'm going to do, since I'm running longer than I thought, I'm just going to go the full 40 minutes. And then if anyone since this is the last thing, if anyone has Q&A, I'll stick around after. And if you want to leave earlier for cocktails, I won't take it personally. The information edge, one. So satellite data is prevalent, commercial, and publicly available. However, we know an Alice manager who has satellite data from a non-commercial international source. And we're being a little bit vague here, but the point is that data is potentially superior because of higher granularity, better frequency, and better spectrum availability. So that could provide the manager with an information edge. So better satellite data, not the ones that are marketing at every conference, possibly this one. 2, behavioral bias, machine bias. We know an Alice fund that has virtual analysts that shorts the FANG stocks, Facebook, Apple, Amazon, Netflix, Google. I was a PM. I know how hard it is to short stocks. I've done it for 25 years. And particularly to short or bet stocks are going to go down that are very popular ones like this that go up every day, often or typically. But they don't always go up every day, and there are periods where they go down and they go down a lot. But an algorithm has no such bias. An algorithm can easily short these stocks. And then the Alice fund has virtual traders that are like risk managers. So let's say they short one of these stocks, a FANG stock, and it's going against them. The trader, again, it's virtual. It's not a person. Just says, okay, you've hit our risk limit, stops it out. And then the manager doesn't fall subject to behavioral biases. Again, we know of an Alice manager using deep learning or neural nets to find alphas that are statistically significant, but may not be comprehensible from a human investment perspective. So, like, we would call that a machine bias. So neural nets find alphas. We don't know why they are. They don't know why they are. The manager doesn't, but they're statistically significant. And then we also know Alice managers that have programmed their machines to be both defensive and offensive because of other machine learning algorithms. So to basically fight off other algos that may be trying to pick them off. So an analytical edge, better analysis. So for example, if you're looking at an oil and gas company, one manager might only look at price earnings. Another manager might look at price earnings, depletion rates of the wells, and reserves. So that's better analysis. That's how you can create an edge. Market microstructure. Our joke here is that it's so small that it's imperceptible to the human eye, the picture there. Right, thanks. No, but seriously, like we have Alice managers that use tick data and clustering techniques to determine when to buy and sell groups of stocks. And that manager, again, may use mean reversion or momentum, but it's based on tick data and market microstructure. This is not something that anyone can easily do. This is a brilliant PhD who we know. Why do you think there's alpha? Regulatory structure. So, there's GAAP, generally accepted accounting principles. There is insurance regulation. Different states have different rules. We know of another Alice manager that's basically exploiting differences in these things. Let's see. Okay, this is a great example. This is a sort of real example from like within the last few weeks. So we mentioned that Alice managers could generate returns from exponential growth of unstructured data. So this is a Chinese news site. Anyone read Chinese here? Or not Chinese, but you know. Anyway, so anyway, this is a Chinese news site that stated changes in Chinese gaming regulations. And apologies, I'm rushing a bit because running out of time. So a Chinese news site said that changes in gaming regulation would adversely impact Tencent. So I'm going to continue this on the next slide. So this is a stock chart of Naspers, which has a material holding in Tencent. So it's like a derivative of Tencent. The article was published at 9:22 a.m. there. So an Alice manager who had an algorithm to read Chinese, parse and trade on unstructured financial data could see that there was at least 20 minutes. You had like 20 minutes there to have sold or shorted Naspers before it started to precipitously decline 6% in only 2.5 hours of trading. So you had 20 minutes there if you had an NLP or a good system to read the Chinese writing, and if you'd automated that, and to generate excess returns. Again, how to analyze the data, understanding bots and noise. Alice managers must understand the data and the integrity and who's creating it and distributing it and why, just like we had Russian election meddling, at least in my view. There can be meddling in financial markets for profit to manipulate securities. And as a manager, you have to be aware of that and account for it, or at least be aware of it, and ideally deal with it. So there are many ways of parsing data. Again, we're at an ML conference. There's Bag of Words, Word2Vec, RNNs with Tensor Network. Again, there are different ways to parse the data. Each has its advantages and disadvantages. Again, there's no panacea. We've seen managers use each of the techniques well. The thing is, you need to do what works best with your system and is cohesive with that philosophy, features, model, portfolio construction, etc. So I'm running out of time, so I'm going to sort of start to wrap up. So what are the three opportunities we see? This is a Frank Lloyd Wright tower. It's called a Mile High, and he did this. When he did this, it wasn't possible structurally. Now it's quite possible structurally, and we're almost approaching it. The first one is building and incubating a new vertical. So like in this conference, in this room, there may be tech companies who are looking to build out an investment vertical. They may have raised a round or two of VC funding, but they need to spend it on non-financial verticals. Data's expensive, trading's expensive, risk management, infrastructure for strategy development are all prohibitive at the R&D phase. So we think there's an opportunity to fund the R&D of the Alice vertical and give the infrastructure and capital to generate a track record. Two, providing seed capital. Again, Alice managers may be at an early stage of development. They may have great intellectual capital, but there's a classic chicken and an egg problem. They can't raise capital because they're too small, and they can't grow because they can't raise capital, and on it goes. No one likes to invest in small managers. So, and they need to demonstrate a good track record, and they have small capital, and the expenses are very high, so the returns are lower. So we think a good solution is to provide seed capital and critical mass so that they can generate higher returns and amortize the expenses over a larger asset base, and then have greater returns and raise more money. Three, incubating the next generation. So there are many young people, again, there may be some of you in this room, who move from the tech industry to finance, from areas like social media, gaming, and hacking. They have an interest and perspective on the markets. We think they're potentially very interesting too. But it's very expensive to try to build out their ideas. They may not have enough capital. They may have paper tracks, back tests, pro formas, hypotheticals that I established are worthless. So we think they need incubation. So we try to work with them. Alice funds, in summary, it's the synergy or intersection of the human, the machine, the data science, the exponential growth of data, the low-cost computing, and playing too close to the information edge. The first wave were discretionary managers. Second wave were quant firms. Third wave are Alice managers. We spent 2 years. We've met with more than 2 years now, over 200 managers. It's been very rewarding. We've oversimplified a lot of it here because it's 40 minutes is long, but it went by quickly, at least for me. We developed an Alice scorecard. The first system, we developed an Alice scorecard, and now our second system, we've got 2.0, and we're using machine learning to rate and systematize and rank and evaluate Alice managers. Again, I think we're the first people in the world to do that, but maybe certainly among the first, if not. And there are 200 managers that portend to be Alice managers, but we've met with them, and some are, many aren't. Many use a little bit. They don't use much machine learning. They don't use much unstructured data. They're not systematic. They don't do it well. They're just pro formas. So there are a lot of reasons why a lot of these managers are not good, but we think it's the first inning, and we think that these managers will win the game. We look forward to spending the next few years looking at, sleuthing out these Alice managers. So I think that's probably the end of my official time. But I can take any questions, and you feel free to go if you like for the cocktails.
So you mentioned that a lot of these managers are not making money, but the good ones, how are they comparing with the ones discretionary?
The good ones are comparing very favorably. They generate high returns and or uncorrelated returns. So like in February when certain markets were down a lot, these managers were up. So the good ones are doing very well. That's where we think there's value to be added in terms of going through like the hundreds out there and determining which ones are the better ones. Other questions? Yeah, standing.
You talked about a lot of these funds who say they are machine learning, they are not. Then you're going and ranking them, but then you're also saying, well, the smaller people don't have the money, you have to nudge. How do you? Are they generating excess returns even with the small capital that they have today, and being able to deploy all these models and still returning the excess returns that you are able to now flow in more capital into them, or how are they surviving? If you say that, okay, there's also the game of, hey, they're starting up and then they're expensive AI that they may not generate the returns.
So it's all of that. Like they're a manager. So it's like we've seen the whole gamut. Like we've seen, we'll invest with a manager. If a manager has like $1 million running capital, and we see that the track record is real, the trades are real, we've gone through them, we've analyzed it, we've gone through their machine learning, we sign NDAs, we've gone through their data sources, we've gone through their process. We believe it's scalable to some reasonable amount. We could invest in or seed or incubate that manager. We've seen the whole gamut. Then also, we see interesting managers. One manager we saw, they trade on earnings announcements. Well, earnings announcements are kind of 4 times a year, right? So it's like 4 times a year they have a great thing to deploy capital in and do, but the other 240 trading days, they have nothing to do. So that's an example where we'll take that manager on our platform and combine it with other managers who have things to do during the rest of the year. And so we could better utilize that strategy, which is capital inefficient, just using capital 4 times a year. As let's say a standalone fund. So there's the whole gamut. We see some managers with great data. We see other managers with great algorithms. We see some managers with great algorithms, but not a good investment sense. So what we're saying is we're going to take all these various disparate parts and we're combining them together and creating, helping them create something that's better than what they have. That's very investable and with uncorrelated higher returns. Other questions? In the red, yeah. So the question was the time duration. So this is not high frequency trading. For those of you that know HFT, this is not about co-location. This is not about latency. This is not about milliseconds or whatever the. Thank you, nano. Yeah, sorry, I'm dated. Nano. Thank you. So these managers are investing for days, weeks, months, even a year. These are again, what I did, what SAC does, or Point72 now, or Soros, or these are sort of normal human investment durations, days, weeks, months, a year. So they're not in that whole HFT game. We think that has regulatory, ethical, technology issues, so we don't want to play there. But there are app managers in HFT using Alice techniques. And there are also crypto funds using Alice techniques. But they can't and don't really short is the truth of it. So that's why they don't, technically you can short Bitcoin, but they don't, so that's why we don't get involved there. Other questions? In the black, yeah.
Are there any those alternative data streams that are commercially available that you think are worthwhile?
Oh God, yeah. So we think that, let me answer it a different way. I'm not going to specify which ones, but I'll say this. The alternative data market is extraordinarily inefficient. Like there are the heavily shopped satellite data, geolocation data, credit card data, and they're everywhere and they charge millions and every fund has it and pays for them. And we think there's very little excess return from those. But then we have managers, these Alice managers who are creative. They scrape the web, they go to public filings, they get exhaust data, they ensemble data, and corporate exhaust data. And that's where they can pay very little or even get it for free and generate significant excess returns. Or again, like I mentioned before, a satellite data from like not one of the big ones that's constantly selling, but from like another country, that actually could be much more valuable than the satellite data that's widely shopped. So data market's very inefficient. I just wrote an article that Kaya is publishing on October 1st called Data to Groove, and it's on the inefficiency in the data market. Other questions?
One more.
Yeah, sure, yeah.
So that, okay, you've lost the bet against Warren Buffett on the hedge funds. So
Well, wait, we like to think we won that, but we can go into that too. We lost and we won, I would say.
okay.
Uh,
Are
yeah.
you willing to bet again so that these funds are going to beat Warren Buffett in the next, whatever, 10 years' time, that they can create that excess return? Or you?
That's a very complicated answer because just as we lost the first bet for structural reasons partially, like betting on hedged funds in a raging bull market and over diversified, and there were a lot of reasons we lost. But we also spend time with Buffett for 10 years. The Girls of Omaha got $2.2 million, not a million even, $2.2 million donated to them. Now we have a building named after us, the Protege Building for the Girls of Omaha. So in many ways, we like to think we won that. But he won't take the bet anyway because he says statistically, I'm not likely to live another 10 years. Any other questions? Okay, I'm told it's curtains. So I'll be around if anyone likes to chat, happy to. Thanks.